And welcome to another fun-filled episode of that 4K podcast. Ari Rosenbaum here with Dan Mantori. Dan, how are you?
I am great, sir. How are you?
I could complain, but nobody would really listen.
That is true. That is certainly true.
Yeah, as this episode drops on iTunes and all other places where you can listen to it, we'll be in Foxborough. So, a week out before events or, weeks out before an event, I always have to fret about attendance and, dot the I's and all that kind of stuff and, pay the catering bill and, make sure the agenda's set and all that kind of stuff. So, always a lot of fun.
Yeah. Yeah, well, so anybody out there who's listening who will be in the Northeast or anyone that just wants an excuse to be in at Gillette Stadium, what's the date again, Ari?
Yeah, but Thursday? By the time they hear this, it'll already be taking place. So
you are right.
Yeah, so we can talk about the MetLife Stadium event, which is on Friday, November the 8th. Which right now we have a really good crowd of advisors signed up. Still some sponsorships still available, which is of course another thing that I have to fret about. But we'll be there at MetLife Stadium, and the guest will be Sean Landeta, which is the great punter for the Giants, two-time Super Bowl champ, and he was a champion with the USFL with the Philly and Baltimore Stars.
And I want to say more, almost as importantly, he was a single bar face mask punter, right?
As most guys were in those days. I mean, Dave Jennings was a single bar kind of
guy.
Sure,
but we don't have those anymore.
I don't think you can have those anymore.
Fair enough.
Matt Barr, I remember, was a single guy. He had a single. But yeah, that was a time and place. I don't think anybody's got that anymore.
I would just that alone makes it worth the trip.
And he dated Donna Rice at one point before the Gary Hart situation.
I was just gonna say, so did Gary.
No, he just.
How different things might have been.
What?
How different things might have been. What were you gonna say? Though? I'm sorry.
No, he sat on her lap. I don't know what went on. Listen, I wasn't on that boat, which was called Monkey Business.
Yeah. What do you think went on that boat?
Listen, I don't know. There? Maybe they're playing chess. What do I know?
Yes, chess. That's exactly what happened.
Exactly. Listen, I don't know what's going on, but that's 32 years ago. That's more important things, like our event at MetLife Stadium, and of course our event in Texas, which is before we know it, it'll be there. That'll be in December.
That is so true.
And
that is so true.
Yeah, and pretty soon we will be having sign-ups for St. Louis in May, and of course we have our Disney events. The Walt Disney World Swan, March the 10th, the 11th, 2020. A great event, great national conference. If you're an advisor, TPA, obviously attendance is open to you. It's only $300 to sign up now. Early bird ends 12/31. Discount Disney tickets, discount Disney rooms. Heck of a 2-day event. Something really, really interesting and exciting and whatnot. So as we get closer to that date, we will be announcing more and more information and speakers and sponsors as well.
Yeah.
So this week, our topic is kind of like plan options, good, beneficial plan options that could cause a heartburn to the plan sponsor. Kind of like one of my favorite sayings is the road to hell is paved with good intentions. To me, one of the most unique characters, the two most unique characters when I think of movie and TV characters that are so tragic, I think of Michael Corleone. And I think of Walter White from Breaking Bad. People who tried to do good in their minds, obviously through criminal activity, but it all blew up in their face. And sometimes in life, the road to hell is paved with good intentions. That you can intend something very, very good, and unfortunately blows up in your face. And when dealing with a 401k plan, I think that's certainly appropriate. I used to always joke that the person who developed that term was probably in the 401k plan business, because the road to hell is paved with good intentions. Because how many times a 401k plan, which was again implemented with the best of intentions, blows up in the plan sponsor's face. And there's some great options within a 401k plan that on paper are great for the participants, but if the plan sponsor or the TPA don't handle it very well, it will blow up in the plan sponsor's face and cause them heartache and may cause them corrective contributions. And obviously an IRS DOL audit's painful enough. So let's start off with automatic enrollment. And automatic enrollment, again, I always thought it was a good feature once they finally implemented it as part of the Internal Revenue Code in 2006, and they made it part and added the QDIA protection. Because back then, when it first came out, I don't want to say 98 or 99, kind of when I started the plan business, automatic enrollment was called negative elections, and that came out of a revenue ruling where I don't know, I think it was a fast food restaurant that implemented the negative election. But the caveat was there was no fiduciary protection for the 401k plan sponsor in terms of where they would invest the money. There was no QDIA at the time. So for about 7-8 years that this was effective, all they could do was put that money in a money market or stable value fund. And once it got codified into law, this was something that I was really a proponent of. I worked for a producing TPA. And I often tell the story that I sent out an email to, the powers that be, including our top salesperson, about why we really need to support this and get behind it, because it will help our plan sponsor clients out, and it will also increase revenue. And I always jokingly say I sent out that email when the law passed in 2006, and as of this day, I still haven't got an email back to talk about it. Obviously, the TPA isn't in business anymore, but the point is that it was a great feature, and it's become, it's been growing more and more acceptance in the 401k plan space. But, we do have compliance issues dealing with automatic enrollment, and that's when the plan sponsor forgets to actually automatically enroll participants, and, it takes time to actually correct that.
It takes a lot of time, and it could create a lot of heartburn. It's the plan sponsor takes on a lot of responsibility, and if things aren't handled as is required, it could lead to that heartburn you're talking about there, Ari. And I think there was a lot of heartburn initially, and that's why, or at least one of the reasons why I think the regs changed a little and become a little bit more forgiving of mistakes that occurred during the auto enrollment process.
Yeah, they so a lot more leeway in terms of time. Back prior to the previous guidance, the moment you goofed and a participant had a missed deferral opportunity, you got to put in a QNAC, and now they pretty much give you 3 months. So if you correct it within 3 months, as happened with my wife's work, where for like a month they goofed, and then she had to double up on her deferrals. So there is more leeway with that. But I mean, there's nothing worse than having to fix an error where your whole job was to withhold money from a participant because they didn't, opt out of the plan, and it's becoming more and more of a problem. And the reason it's becoming more and more of the problem, honestly, is because automatic enrollment is becoming more and more accepted in the 401k world.
Yeah.
So obviously, when you see an option get added, obviously it's going to cause a lot of mistakes. And these are big mistakes because, again, when you think about it, a plan sponsor having to make a QNAC for missed deferral opportunities, to me, is the biggest point of wasted money, in my opinion, because, the participant wasn't putting in money, couldn't put in money because of, your malfeasance, and now you're going to have to pay for it. So it's a costly error. It's an unnecessary error, but it's an error that we see from time to time. Not as prevalent as my favorite mistake, which is plan loans. I love the idea of loans. I love giving the option to participants to take out a loan they should always access their money. Listen, I've gone through a hurricane, and I've gone through experiences like buying a home. You want to access the money if you can, but there's a right way and a wrong way to do it. And the wrong way to do it is when plan sponsors offer unlimited plan loans and no minimum loan amounts. So, I always tell the story of a client who, they had participants with 8 or 9 loans. The problem with 8 or 9 loans is it's like juggling. The TPA is juggling in terms of pushing the payments off to certain loans. And a lot of times when juggling, you drop a ball. And so when you have 8 or 9 loans to pay off, a lot of times the TPA will pay off 6 or 7 of them. And then you might have a defaulted loan because a quarter of the year went by and no payments were made to pay off the loan. And, asking a participant and telling them that you're going to issue them a 1099 for a defaulted loan, a deemed distribution when it wasn't their fault, that's a hard conversation to have. At least I think that way, especially when it's the TPA's fault or, maybe the plan sponsor's fault or even the payroll provider's fault. It happens. And I think the best avenue to avoid a problem is not to seek it. And the way not to seek it is to, again, offer one loan outstanding at a time, minimum loan of $1,000. If they want to refinance, give them that option, but one loan outstanding at any time. Because you don't drop the ball when you're only juggling one ball. I'm sure you can do it, but it's less likely that you can.
If you can't keep one ball in the air, bud, there might be some bigger problems. But yeah, I mean, we see a ton of, right, there's a ton of loan activity in general in our plans. The game that I think we most frequently see, and we try to I don't want to say you can't prevent the game, but you try and discourage it. Folks pay off the loan that's coming to an end just to borrow a bigger amount, right? When we have limited loan situations like that, we have one plan that there's several participants that are in the high teens in terms of total loans taken out, and the plans are less than 5 years old.
Right, and then you have people taking out $250 loans and paying a $50 or $75 loan application. It's ridiculous. The 401k plan should be an opportunity for participants to access their money, but it shouldn't be a payday loan service.
No, entirely. It's not an ATM. Some of my absolute favorites are we've had this a few times. Participants that are looking at a foreclosure or an eviction, something that they've had visibility to, right? Not the event that happened out of the clear blue sky yesterday and you weren't quite prepared for, but something that has been slowly coming for a really long time, and then they sort of expect that loan or whatever to just happen immediately. I mean, maybe that's more an administrative bent than a legitimate gripe, but that's certainly something that I chuckle about sometimes.
Yeah, I mean it's a recipe for disaster, and again, when you ask for trouble, you'll find it. And I just think that it's something that it just easily could be avoided by having a loan program in place that allows participants to take out money, but in a way that administration isn't going to be, flummoxed or, just putting a wrench in administration by, like I said, offering, participants to take out a $200 loan and pay a $50 or $75 loan application fee. Yeah.
Agreed. No, agreed.
And, sorry.
No, go ahead. What were you going to say, sir? What's next on the list?
Well, hardships. That's another thing that I think that I don't think it's become a big problem, but I think that eventually it will be a big problem. First of all, we have a change in the hardship provisions. No kick out of 6 months. There's no default. There's no suspending electives anymore. Now participants can access their QNEC and Safe Harbor that they weren't able to and before. But I think that the looming problem with hardships is in the substantiation part of it. That I think that the IRS and over the last couple of years has really stressed, during an audit, they want substantiation of hardship requests. So, there were plan providers out there who had some kind of service where they approved hardships and the plan sponsor no longer had a say, even though the TPA who was doing it wasn't a fiduciary and absolved themselves of any fiduciary capacity and all that stuff, which if it ever went to court, good luck to that provider. But to me, substantiation, not taking people's word for it as to when they want a hardship. And really being strict when it comes to the hardship rules and making sure that any requests are within the safe harbor criteria.
1 of 6. We've had many conversations with participants explaining those 6 qualifying reasons. We're hopefully coming to the end of audit season here in the next week or so, at least for a vast majority of us. And I can tell you that in each one of the audits that we've done, and I'm sure the ones that you've been involved in as well, are they want that substantiation. I mean, we had one auditor that we had an RMD in one of the plans, and they, sure enough, they wanted to see something on that. So every form of transaction, I mean, we even on sort of similar.
The connection's a little bad. You're breaking up. I can barely hear you.
So yeah, just another.
Anytime you're talking, it's going out.
You stopped it.
And we're back. Dan had some, technical difficulties?
Technical difficulties.
Okay,
yes.
So what were you saying?
I don't know where we cut off, but I think I was in a rabbit hole talking about
hardships.
Hardships and the need for documentation, talking to participants, asking them, to provide all that stuff. That's kind of one of the things that plan administrators do. Inevitably, that's one of the things that most plan sponsors have to deal with. Keep track of that stuff. I mean, auditors are asking for it. I'm not sure exactly where you had lost me, but I had sort of pivoted over to the documentation requirement on loans for primary residence. Anything that extends that duration past 5 years.
Oh, absolutely. And
so, document it.
Of course, absolutely. And last but not least, matching contributions. I love matching contributions. However, I've seen too many problems with it. And namely, it's when you have funding issues where maybe your plan document says you should fund one way in terms of the compensation limit that you're looking at, and you fund it a different way. So perfect example is when you have a cap on your match, but it's an annual cap, but you've been doing the match on a weekly basis or payroll basis. That presents a lot of times where you need a true up or you need to correct it because the problem is that plan participants, change their investments or change their deferral percentage throughout the year. And then, of course, some employees, like my wife, max out before the year's up. So you don't have that kind of fluid, consistent deferral rate. And that's kind of why I like an annual match. But, I understand participants want to see that money coming in every payroll, and it's nice to look at and see and all that stuff. But sometimes that payroll period match can really get screwed up be miscalculated, and of course, because, like I said, participants don't defer on a uniform rate. They change. Money might be tight. They maybe get a bonus or that sort of stuff. So the matching contribution can just be really a headache when it really didn't need.
Mike Jackson's kind of.
Say that again. Well, anyway, the problem is that matching contributions could be a huge problem when they really don't need to be. And I think that really you need to have, annual annual matching contribution deposits rather than payroll. But if you do it payroll, obviously make sure that the caps that you're using are on the same, annual or payroll limit or whatever it is. So you just have the funding and obviously the contribution have to be consistent. So thanks to some technical difficulties, we're just going to probably put a knot into this one because, we talked about all the situations where plan provisions that are beneficial to plan participants may lead to some bad results for the plan sponsor. So until next week, Ari Rosenbaum, Dan Ventori saying so long.